Good day, fellow investors. Today I'm bringing you an overview of Shell. From a value investing approach, Shell is a diversified energy business focusing on profitability, LNG growth, and less on recently, transition. From Moat, they have scale, integration, LNG leadership, and a strong brand. Reasonable incentive structure for management, prioritizing shareholder returns, and very pragmatic. From a margin of safety perspective, they trade to a slight discount compared to US peers. So let's dive deep into Shell. What do? They have a deeply integrated system with upstream, LNG, downstream, you name it. They are in trading, branching into renewables and energy solutions, although as later you will see, that's been less of a focus, not just for Shell, but in general, BP and other majors who went too heavy on renewables and found out it's not really profitable to do so. That's where you see a positive shift from management, is that they are shifting towards profitability, meaning prioritizing profitable projects. Cost cutting, they are planning to do almost 4 billion over the coming years of structural cost reforms. Moderate CAPEX, you will see a couple slides later some numbers on that, and really importantly, shareholder returns. That's the priority. So I would like to also bring up some rumors. BP acquisition is not being considered by Shell according to their latest statement, which was this summer, I believe June. And they are reviewing a listing to New York from London. But I would go one step further and actually watch out if they would redomicile to the US. So there were multiple companies leaving Europe, especially the Netherlands. Unilever is a great example, or like are planning to leave to a friendlier jurisdiction with less regulation. This could be an upside potential for Shell just from a speculative perspective without looking at the business, but possibly helping the business, right? With lower regulation, taxes, better access for capital. Their goal is more value with less emissions, stating they're gonna focus more on LNG with a nice 4 to 5% growth, sustaining liquids production, and expanding into downstream and renewables for resilience and returns. So from a oil company perspective, if you're heavy on upstream, meaning production, you are really exposed to global commodity prices, oil and gas. From a downstream perspective, that could help you to stabilize the business, depending on, although that's also cyclical. So your crack spread, if you are a refining business, is cyclical. If oil prices go up, usually you have a higher crack spread because the global economy is doing well and you have nice demand. Although that's a great point to diversify and make the business less volatile. Renewables, well, electricity demand is going to increase. So if Shell is trying to capitalize on that, and they do, that's great. Although renewables haven't really been profitable for most companies yet. So let's look at the segment breakdown. I want to focus on the right side first. So you can see that gas is a huge part of their business with production. That's bread and butter. You have marketing, right? Shell is a really good, strong brand for like commercial marketing perspective. They have a lot of stations across the globe. You can see chemical products. Recently, actually, Occidental Berkshire deal was announced, not a deal, but Berkshire wanting to buy Occidental's petrochemical business for around $10 billion. I'm not sure. Yeah, that makes sense. Shell has a business like that. It's small. So I'm thinking that, okay, where are we in the cycle? Currently, if you look at chemical companies, they are not doing great. Is it the bottom? That's why Berkshire wants to buy Oxy's business. Maybe it is, maybe it's not. We'll see if next year this segment improves compared to this year. Now you have renewables and energy solutions at a negative $100 million. As said, it's not really profitable as of now. So what I want to look at is CAPEX, because the previous slide I said they are cutting costs, focusing on profitability. You can see that in their CAPEX. It's going down. Guidance is around 20 to 22 billion. And then also what's interesting is the breakdown of their CAPEX. So integrated gas, which is making the most money for them, CAPEX is slightly up, 10%-ish, a bit more. Upstream production, sort of flat, a bit down. Marketing is cut. Okay, chemical products, and the bigger one is, I would say, is renewables. So you see over the past years a relatively large drop from 22 to 24 in spending there. Frankly, I just want them to make money and be profitable. If they do projects that do not make sense, then it's just the destruction of shareholder value. And also resources, right? Because in the world we have resource constraint. You have to use your resources to make value out of them. So for example, if you use natural resources worth of $10 and you make something worth $3, you destroyed value. I don't want them to do it. It's as simple as that. Let's look at the moat Shell has. So from a pure supply curve for their oil, Shell is sitting sort of in the middle. Although if you look at across the company, because of the large diversification across gas, oil, LNG, fuel stations, they have a less volatile business than others, and you can compare free cash flow to other oil companies compared to Shell. Shell is not as highly volatile to oil than many other, although it's an oil company mainly, so it's still volatile. Integrated value chain provides, yes. Global leader in LNG, that's really important, especially in Europe, and if you consider East Asia. Strong brand, yeah. Retail presence is Shell is actually a good brand. So thinking about, it's hard to quantify this, but if you think about driving around, you see a Shell, you recognize, you trust it probably better than some no-name or small stations. And also Shell is a European company. It's a strategic partner in Europe, so it's hard to see them go out of business. Let's look at management. They were recently criticized, and in the past also criticized, for their inconsistent renewable strategy. Now they turn away also from that, and I like this change. So their CEO emphasized shareholder returns and pragmatic transition. That means value creation. What does it mean? It means balanced dividends, balanced buybacks, and balanced CAPEX. If this portion we look at on the right side, what do you see? You see a total distribution of over the cycle of 40 to 50% of cash flow from operations. Great. Part of it will come from dividends, part of it from buybacks. Good. Half of the CFFO comes from, it's amazing. And then you have a CAPEX of 22 billion across this period. We'll see one slide later what does that mean, because is it growth, is it maintenance, is it below maintenance, right? So we have to figure that out. And this portion here is really important, to do projects that make you money. Also here they focus on the big parts, the profitable parts, integrated gas and production upstream. These where most of the CAPEX go. I like this. I like this shift. I like profitability. I like shareholders. I didn't like wasting capital on future, on hope or predictions. Oil is gone in 10 years. It doesn't make any sense. Coal production, I think in the UK, peaked in 1913 in the UK. But coal is still breaking production globally. And it's been 100 years since the big coal country, UK, peaked its production. So it's still here. It's just an additional layer. Maybe I could have added a slide on that energy breakdown from by sources like oil, gas, nuclear. It's just you need more and more energy, and you don't really transition. You add on top new sources of energy. So this is a great approach from capital allocation and shareholder returns. And what I really like about Shell is their transparent incentive structure, which also makes sense. So this is the short-term year bonus metrics. You have cash flow from operations. Great. asset management excellence. I don't know how they calculate it exactly, but looks fine. Great. LNG volumes, yes. Emissions, okay. Safety, makes sense. These are business numbers. So what I really don't like is when companies have an incentive structure based around, let's say, adjusted EBITDA. Okay, that can be anything. Or share price performance. Like, okay, what if the market's up? You didn't do anything good, but you are rewarded. That doesn't make sense. And from their long-term incentive plan from 2022 weighting, you have cash flow from operations growth. Great. Total shareholder return. Share prices I don't like that much, but because it's against other majors, so they are influenced by the same macro conditions. If Shell is performing better than its peers, that also makes sense. It includes buybacks, dividends, so all that picture, how it translates. Yes. Investment, capital allocation, yes. Performance, internal, free cash flow, perfect. Energy transition, okay, it's a political issue, and we have some growth there. I want to see energy transition to be profitable. Then you will see more. There are some 2024 changes, but organic free cash flow, great. Energy transition, I just said what I think about it, and other performance metrics. Okay, all nice. Let's look at CAPEX history. So this is when I said about CAPEX, what it has to be put in a context. So you see through the cycle, purple is cash flow from operations, and DDA, which is depreciation, depletion, and amortization, which means they are running out of oils in their reserves, their equipment is amortized. So this is a good proxy to get a sustaining CAPEX number. Of course, CAPEX is cash CAPEX, while this is an accounting term, but the DDA, but it's a good proxy. So if you see that CAPEX is lower than like the last year, CAPEX is lower than DDA, that means there's a probability they are investing less than to sustain the business long term. Although that could also mean that they have assets, and they do, which just depreciate, and they don't really focus on replacing that much. Maybe they have a lot of renewable unprofitable assets, and they just maintain it, or cut some, or sell off some. So if this would mean not huge growth overall, this doesn't mean that gas is not growing, because that's their goal, to focus on gas. So this amount mainly goes to core areas and less non-core. This means basically they are readjusting themselves. They are not crazy fueling growth, that's what they say. They want a balanced capital allocation, reward shareholders, and be profitable. All lines up. And from a shareholder remuneration history, you can see the free cash flow and then dividend and buybacks. I said it a couple of times that, let's look at 2022. You had $90 to $100 and more oil prices. That's when you do buybacks. I don't understand. I understand that you have a lot of cash at hand, but you do buybacks when your share price is sky high. That's what I don't like in general on commodity and other cyclical businesses. When your stock price is up because the underlying commodity is up, that's when you have cash and you buy back. Well, I think there could be other ways to manage your finances. They are consistent dividend payer and a consistent buyback. They are doing consistently buybacks. During COVID, they cut their dividend into half because of the low oil prices, and they are yet to recover actually to the levels they had pre-COVID. But as you can see, they paid huge amounts here. For example, they paid more than their free cash flow, so that came out of reserves or maybe borrowing even, and financing. Okay, look at the margin of safety valuation. When I did a short projection, I used a 10% discount rate. I used these oil prices, and I came up with a number of 99. With the production, they are, with the CAPEX they are saying, I used the average of the guidance. Break-even prices they have, from oil perspective, they are pretty low. It's just a proxy for me to do the calculation, and this is the production curve. It's barrel equivalent oil, so it's obviously not all oil. And my projection based on these numbers came out of 99. I put it into perspective. So if you look at the 10 cap valuation, this is for 2024, which means the free cash flow times 10. That's what the company should be worth at the 10%, if you want a 10% return, if you would be, in theory, the sole business owner. Then the company would be worth 120 per share. But 24 wasn't it was $80 oil, so that was higher than today. If you look at the 7-year average, 10 cap, then you are at 100. So my projection is kind of in the ballpark. I would run with mine, 99 per share, if you want a 10% return long term across the cycle. And of course, if oil prices average higher than these, of course, as you go down the years, these matter less because of the discounting. But if oil prices go up, their value goes higher. If they go down, their value goes lower. Maybe they cut more CAPEX, maybe they restructure. But you can see a lot of news around ConocoPhillips, Chevron, Exxon cutting staff, like 20-25% of staff for Conoco. Similar for Chevron, and Exxon is just looking at other cost-cutting strategies. You hear Occidental, you look at the break-even prices, you look at reports of the US shale and break-even prices, you see that, okay, how much downside you have for oil, because many US shale is not truly profitable with new wells at these prices. So what's your downside? What's your upside? I think you have more upside than downside, but we'll see how's that. So let's look at profitability. You can see that return on equity 19.5, return on investment 9.1. They are both above the 7-year average, but you can look at the cyclically adjusted, basically a 7-year average. These are okay numbers, not outstanding, but the business is a cyclical oil business. They have manageable amounts of debt. Easily they can cover their interest payments, and then they have a cost of debt of 5.9. It's obviously higher than the 7-year average because of the higher interest rates today. Of course, they are exposed to price volatility, regulatory risk, regulatory tightening, climate litigation they had some issues with, and stranded assets, like the Russia-Ukraine situation caused some issues. So maybe you remember that BP lost like 25 billion and lots of their reserves in the Russia deal because they just sold it for like €1, all the 25 billion worth of assets. And given Shell is globally present in multiple countries, not all countries' jurisdiction is as friendly as your home country. Transition investments, uncertain in profitability. Yeah, that's my point. I like that they focus more on profitability. If that includes green, I don't mind. If you have to pay to invest and have no return, it doesn't make sense. And trades at the modest multiples versus US peers. So if you would compare to Exxon or Chevron, although those companies have a bit better balance sheets, they have less debt, more liquidity. But if you just compare them, US companies in general are trading at a higher valuation than any other company. That's why I generally like to look at non-US companies, because you get better deals there. And looking at the stock summary table, so far this is what we've covered. You can see that according to these numbers, you have a pretty nice upside for Shell, but I would say these are long-term ideas, and everything is around 10%. What should be the share price if I get a 10% free cash flow yield? That's the whole idea. And then now you have to discount for risks. So for example, maybe Petrobras can give you a 26% last year yield. Okay, maybe they give it half of it as dividends, so let's say 17-18% dividend yields, but you have emerging market risk, you have political risk, you have price volatility risk, all sorts of risk you have to discount for. And then you have businesses like BAT, where it's just hated by ESG standards, funds cannot invest in them. So you have other type of risks there, but they are more low volatility business, and they are cheaper because they are hated and because they are non-US. If you look at Philip Morris, there is no upside. I spoiler that because it's highly valued. And then you can compare the two and say like, okay, why would I buy Philip Morris at like 20 PE when I can buy British American at 9 PE? So those are the US, non-US stock reasons I have. That said, if you enjoyed the video, please like and subscribe. Leave any comments, what stocks you would like to want me to cover. Other than that, have a nice day and take care. Cheers.